inventory. So when we are dealing with inventory, this particular inventory is governed under IAS number 2, IAS 2. So IAS 2 inventory give definitions of what is actually your inventory. It is very make sense to say that inventories is something that we actually buy from other people's and we resell to anyone, for example customer, to get profits. So in this case, inventory under IAS 2 is defined as the asset that is held for sale in the normal ordinary course of business. So we can buy a finished good and sell the finished good by mark up certain profit to the customers. And it could be the asset used in the process of productions for the sales. Sometimes we are not going to buy from third party and sell to another one. We are going to buy the raw material and we develop the inventory by ourselves. And this is so-called used in the process of productions. So the inventory here is not just limited to finished good. It can be your raw material, it can be your work in progress, and it can be your other kind of inventories that you are dealing in the productions. And any form of material supply consumed in the productions, and this is your raw material. So inventory itself can be from different stage. So this is the definitions. And following to these definitions, we will study a most important concept in IAS 2, that is inventory must be valued at the lower of cost and NRV. So meaning to say, when we are doing our inventory valuations, it is an important step for us to compare our costs, meaning to say the amount that record by ourselves compared against the net realizable value. This is the sales that currently you are selling, how much minus any cost to make the sales or cost for complete the things into finished good conditions. So for example, if I'm saying that my cost in my financial statement is recorded in 1000, so this is my cost. But if let's say the NRV maybe in a future date but before the annual report published, this is also governed in IAS 10. So if our cost is 1000 but our selling price is 800, what does it mean here? It means that our asset in financial statement has been overstated by $200. So in this case, we will need to bring down this 1000 ringgit. We will need to bring down this 1000 ringgit to equals to NRV because we have overstatement by $200. So this overstatement, we are going to debit our loss of inventory, and this loss of inventory is your expenses, that's why in debit side, and we are going to credit our inventory. Originally our inventory at 1000, when we credit it, it will become 800. So 1000 minus by 200 equals to 800. So when we can conclude that when our cost is more than our NRV, meaning to say we have overstated our asset. And overstatement of asset is something that is prohibited under prudent concept. We can also say that this lower of cost and NRV is actually consistent with prudent concept that we learn. And here, if your cost is more than NRV, we are going to record the difference as a loss of inventory under SOPL by debit expense, credit inventory asset. And our inventory now will be carried at NRV. This is what I have mentioned just now. And how if your cost is less than NRV? In that case, no action needed and your inventory can be continued at cost. So your example is very straightforward. If for example, my financial statement cost is at $700, meaning to say we have passed the IAS 2 valuations lowest of cost and NRV. We are carried at the lowest of cost and NRV. So we are doing it correct. And when we are doing it correct, no action needed, no adjustment needed. And this is what we are trying to say in this part. So, more than NRV, adjustment. It doesn't more than NRV, no adjustment. And some things that you need to know under IAS 2, when we say we are comparing cost and NRV, cost is actually making from purchase price plus any costs of conversions. Cost of conversions like your direct labor, direct expenses, and also overhead expenses. You need to convert the raw material into finished good. You need to incur that expenses or any other cost that bringing your inventory into present location and condition. Something like your IAS 16. Any cost that you need to incur in order to get the inventory, then you need to include that part of the expenses inside your cost as well. Example, like your duties, tax you need to pay in order to get the inventory. So this is include means plus. And IAS 2 specifically exclude abnormal wastage, storage cost, unless the storage cost is needed at the initial stage that to bring the asset into present conditions, unless it is present locations and conditions. Admin overhead excluded and selling costs excluded. When we talk about NRV, net realizable value, the base is always selling price. And we will need to minus any costs to make the sales. Example, such as the commissions that we spend to actually ask the agent to help us to sell the asset, the inventory, sorry. And we will need to minus any costs to complete the inventory. This is pertaining to the case of WIP. And this is for your net realizable value. So you need to minus these two in order for you to compare cost and NRV. Just give you an example. If let's say your cost include any direct attributable cost is 1,000 and this is your cost for finished good, and we need to compare with NRV for finished goods. And if you see the comparison here where your NRV still lower than the NRV is lower than your cost, meaning to say we have overstatement. So in this case, there is a loss of inventory. So this is comparing finished good to finished good. But if let's say I'm telling you this is a cost for WIP, the WIP cost is actually, for example, 700. And this is WIP as I mentioned, but this is finished good. Can you compare in this case? Definitely not, because finished good and WIP, they are different stage. So if this is your NRV for finished good, you will need to minus your cost to complete this work in progress stocks. So in this case, if let's say I have completed, for example, work in progress, I have completed 60%, the completion is 60%, but the cost to complete for that remaining 40% of to make the work in progress complete to finish good is 120 example. Then you should always use your finished good minus your cost to complete. Then only you can make a comparison. So this is why you need to minus cost to complete in your finished goods. In your net realizable value. Something that you need to take note. If your work in progress if your NRV is already work in progress value, meaning to say no adjustment needed. But normally, it makes sense that the NRV we got always is for finished good. That's why we need to do this step to move backward. Actually, 680 is the NRV for work in progress. Then we can compare. So this is what you need to know for your entire IAS 2 as for a simplified versions. And now, let us look at a simple example where further things might be complicate the entire case. So in 31st December 2086, the total inventory unit is 5,000 and we have 5,000 unit of inventory. However, that 5,000 unit of inventory include 1,000 binding sales. So binding sales in here meaning to say that sales we already buy before the year end, but we are going to deliver after the year end. As you can see, the year end is on 31st December 2086. Meaning to say that binding sales, we have confirmed and locked the sales price during the year end, but subsequently, after 1 month later, only we will sell it off, transfer out to my warehouse, from my warehouse. So in this case, this 1,000 is still inside my warehouse as part of my inventory. That's why I got 5,000 unit. But the thing is that when binding sales happen, this binding sales has their own specific price that we agree with the customers. So out of this 5,000 inventory, you will have two categories of inventory. One is normal inventory or non-buy inventory. Another one will be your binding sales inventory. So non-buy and binding sales, non-buy is 4,000 unit because we know that 1,000 is buy sales. And from here, you will treated them into different class of inventory in order to value the total inventory of your business to be captured in your SOFP. So they say the inventory purchase price is 140 and duty is $60. So in this case, 60 ringgit, sorry. In this case, your total cost is RM 200. And we know that the cost is 200 for binding sales, also 200. Estimated selling price is 310 and commissions to agent is 10 ringgit. So in this case, the NRV will be 330 minus 10. You are going to get 300. So your NRV here is 300 for non-buy sales. What I didn't calculate for binding sales, the reason being is that buy sales, we are selling at 200. To find the NRV for buying sales, you will need to take 200, the price that locked in the year end with a customer on this buy sales, minus the commissions. We assume that these commissions is part of the things that you need to incur for the sales. So your buy sales NRV is 190, and then only you can compare. So based on these situations, non-buy sales, lowest of costs and NRV is still your cost, so no problem. But your buy sales, lower of cost and NRV, that will be your NRV. And therefore, your inventory should be used 4,000 unit times 200 and 1,000 unit times 190. So this is the value of inventory, and your total value of inventory will be 800,000 plus 190,000. And this will be your total inventory value at the year end. So whenever there's a different class of inventory in terms of buy sales and non-buy sales, you will need to separate it out, the calculations. Some question can ask you, damaged goods and normal goods and damaged goods, they have a separate net realizable value. You need to separate out like what we did in here. And that's all for IAS 2. And the most important concept here, you need to remember, always lowest of cost and NRV, in line with prudent concept. Thank you so much.